Are you ready to unlock the secrets of intelligent investing and secure your financial future? In this video, we'll distill The Intelligent Investor by Benjamin Graham into actionable insights that will transform your approach to money. This video is your key to financial empowerment, whether you're a 9-to-5 warrior, an aspiring entrepreneur, or a lifelong learner. But here's the twist: we won't bore you with finance jargon. Meet Mr. Market, master the margin of safety, ride the stock market roller coaster, and embrace the power of diversification. Let's dive into The Intelligent Investor by Benjamin Graham, where continuous learning leads to financial prosperity. Chapter 1. Investment versus speculation. In Chapter 1, Graham draws a clear line between investment and speculation, a fundamental distinction for continuous learning in finance. Investment is the art of researching a company's fundamentals, analyzing its financial health, and determining its intrinsic value. It's akin to being a meticulous detective, gathering evidence before making any investment decisions. Speculation, on the other hand, relies on predictions of short-term market movements without substantial research. It's like gambling, placing bets based on emotions and market sentiment. Understanding this difference is crucial because it sets the stage for intelligent investing. As learners, you should always prioritize long-term value over short-term market fluctuations. To illustrate this point, consider the story of Mr. Market. He's an imaginary business partner who offers to buy or sell his share of a business every day. Some days, he offers to buy your share at a high price, while other days, he wants to sell it at a much lower price. An investor would calmly assess the business's fundamentals, while a speculator would react emotionally to Mr. Market's daily offers. This example illustrates that investors focus on the intrinsic value of the business and are not swayed by Mr. Market's erratic behavior, while speculators chase short-term price fluctuations. Chapter 2. Mr. Market. In Chapter 2, Graham introduces the character Mr. Market, a personification of the stock market's daily mood swings. Mastering Mr. Market is pivotal for value providing as an intelligent investor. Mr. Market can be irrational and unpredictable, offering you varying stock prices every day. The key takeaway here is to exploit his mood swings to your advantage. Buy when he's pessimistic, stock prices are low, and sell when he's overly optimistic, prices are high. This strategy aligns with the timeless principle of buy low, sell high. In essence, don't let Mr. Market's emotions dictate your investment decisions. Use his mood swings to make rational choices. To illustrate the concept of Mr. Market, imagine a scenario where Mr. Market, in one of his enthusiastic moods, offers to buy John's shares of XYZ Corporation at a price significantly higher than their intrinsic value. John, being an intelligent investor, calmly declines the offer, recognizing that the stock is overvalued. This example demonstrates how investors can resist the temptation to sell their stocks during periods of market euphoria and instead adhere to their valuation principles, just as John did. Chapter 3. Margin of safety. In Chapter 3, Graham introduces the concept of the margin of safety, a fundamental concept for risk management. Margin of safety is like a safety net beneath your financial tightrope. It involves buying stocks at a significant discount to their intrinsic value, providing a cushion against unforeseen market downturns. Investing with a margin of safety minimizes your risk of losing your hard-earned money. It's like having a financial backup plan in case things don't go as expected. This principle encourages cautious and prudent investing, safeguarding your capital. To illustrate the importance of the margin of safety, Graham presents the scenario of two bridges built by engineers. The first bridge is built to withstand a maximum load of 10,000 pounds, while the second is constructed to hold 20,000 pounds. If you plan to drive a truck weighing 9,000 pounds across these bridges, which one would you choose? The choice is obvious: you'd select the second bridge because it offers a margin of safety. Even if there are unforeseen circumstances, the bridge can handle the load. Similarly, in investing, a margin of safety ensures that even if things don't go as planned, your investments have a buffer to withstand adverse conditions. Chapter 4. Long-term investing. In Chapter 4, Graham emphasizes the significance of long-term investing, a key component of continuous learning. When you invest with a long-term horizon, you give your investments the time they need to grow and compound. Think of compounding as a financial superpower. It's the process of earning returns on your initial investment, plus the returns on those returns, and so on. Imagine it as planting a seed and watching it grow into a massive oak tree over time. The longer you leave it, the bigger it gets. This is the essence of long-term investing, harnessing the power of time. To illustrate the benefits of long-term investing, Graham introduces the idea of an investor, Mary, who purchases shares of a company at $100 per share. The company pays a dividend of $5 per share annually, which Mary reinvests. Over the years, the company's stock price and dividends grow, and Mary's initial investment multiplies many times over. This example illustrates how compounding can turn a modest initial investment into substantial wealth over time, emphasizing the importance of patience and a long-term perspective. Chapter 5. The Defensive Investor. In Chapter 5, Graham focuses on the defensive investor, advocating steady growth. A defensive investor seeks simplicity, diversification, and stability. It's like constructing a well-balanced portfolio that can withstand various economic conditions. Diversification is your shield against concentration risk. Just as you wouldn't put all your eggs in one basket, don't put all your money into one stock. A diversified portfolio helps you achieve steady, consistent growth. This chapter teaches the importance of aligning your investment strategy with your risk tolerance and financial goals. Graham describes a conservative investor named Susan who builds a portfolio consisting of various types of assets, including stocks and bonds. She allocates her investments based on her risk tolerance, aiming for stability and regular income rather than high returns. This example demonstrates the importance of diversification and tailoring your investment strategy to match your financial goals and risk tolerance. Chapter 6. The Enterprising Investor. In Chapter 6, Graham introduces the enterprising investor, encouraging continuous learning and active management. The enterprising investor is like a detective who thoroughly investigates potential investments. They actively manage their portfolio and dive deep into a company's financials. This approach seeks out opportunities that others might miss. Being an enterprising investor demands time, effort, and a commitment to staying informed. It's like being on a quest for hidden treasures in the world of stocks. This chapter underscores the value of diligent research and active participation in your investment journey. To illustrate the concept of an enterprising investor, Graham presents the story of an investor, Tom, who thoroughly researches a company's financial statements, industry trends, and competitive positioning. He identifies a stock trading at a substantial discount to its intrinsic value and decides to invest. This example highlights the importance of in-depth research, active management, and the willingness to put in the effort to uncover undervalued opportunities. Chapter 7. Market Fluctuations. In Chapter 7, Graham explores the inevitable market fluctuations. Understanding these fluctuations is crucial for continuous learning in investing. Market fluctuations are like the ebb and flow of the ocean's waves. They are natural and can be your allies. During market downturns, you have the opportunity to buy quality stocks at discounted prices. Embrace these fluctuations. Don't fear them. Remember, buy low, sell high, is the key to successful investing. Graham references the stock market crash of 1929, one of the most significant downturns in history, to illustrate the concept of market fluctuations. He describes how many investors panicked and sold their stocks, suffering substantial losses. This example emphasizes the need for emotional resilience and the wisdom of maintaining a long-term perspective, even during turbulent market periods. Chapter 8. Investor Psychology. In Chapter 8, Graham delves into investor psychology, a critical aspect of emotional resilience. Your emotions can either be your greatest asset or your worst enemy when it comes to investing. Fear and greed can lead to impulsive decisions that harm your portfolio. Stay disciplined and stick to your investment plan. It's like having a compass to guide you through the emotional rollercoaster of the stock market. This chapter highlights the importance of maintaining a level head and staying true to your investment strategy. To illustrate the impact of investor psychology, Graham discusses the behavior of investors during a stock market rally. Many individuals become overly optimistic, buying stocks at high prices fueled by greed. Later, when the market experiences a downturn, fear sets in, and they sell their holdings at a loss. This example emphasizes how emotions can lead to irrational decisions and underscores the importance of discipline and self-control in investing. Chapter 9. The Stock Market's Wild Ride. In Chapter 9, Graham takes you on a thrilling ride through the stock market's ups and downs. It's about embracing the roller coaster of continuous learning. The stock market can be volatile, but within that volatility lies opportunities. Like a roller coaster, it can be both exhilarating and frightening. Just remember, you're in it for the long haul. Buckle up, enjoy the ride, and stay focused on your long-term goals. This chapter instills the importance of patience and perseverance in the face of market turbulence. Graham recalls the tumultuous events of the Great Depression, during which stock prices plummeted, causing widespread panic and financial hardship. Many investors suffered significant losses during this period. This historical example serves as a reminder of the stock market's unpredictability and the need for a long-term perspective to weather its wild fluctuations. Chapter 10. Intelligent Investors and Active Management. In Chapter 10, Graham discusses the traits of intelligent investors and provides an example of adaptability and continuous learning. To illustrate the concept of adaptability and continuous learning, Graham highlights the story of an investor who, over time, adjusts their portfolio strategy to align with shifting economic trends and financial landscapes. This example underscores the value of flexibility and the ability to evolve one's investment approach in response to new information and market developments. This chapter emphasizes the theme of adapt and thrive, underlining the importance of continuous improvement and flexibility in your investment journey. There you have it, a comprehensive exploration of The Intelligent Investor by Benjamin Graham, enriched with examples from the book to illustrate key learnings. These examples offer practical insights into the principles of value investing and emphasize the importance of discipline, patience, and continuous learning in the world of finance. If you found this video enlightening, give it a thumbs up, subscribe for more enriching content, and hit the notification bell so you don't miss any of our future videos. Until next time, happy investing, and keep learning.